Welcome back. It is one of our favorite segments on the show. It's called Let's Talk Money, and we have Brent here, of course, from Wilsey Asset Management. This is cool because you answer some viewer questions. You come up with talking points we may not think of. Today's big question is using part of your 401k for a down payment on your home a good idea? Lots of opinions on this. Where do we start talking about this?
Well, let's start because the reason it came up is the administration, the president says, gee, we want to help people, younger people get a home, people can't afford their first home. We want to help these people get their first home. So he's come up with the idea, maybe we should take money out of the 401k for your home. Now, I'm going to say this is a terrible idea because it's great now, but people just are not thinking down the road 20, 30 years. And this thing called Social Security, it will be around, but you cannot retire on that. And the problem with that is that you need to have a good 401k. We talked recently about building your 401k. You don't want to build it, take it and put it in your house. I've had clients where they call up and say, I'm locked here. I need money because insurance is up, this is up, and they didn't put enough in their 401k to build the retirement account, and now the house is costing them more than they can afford. And I've unfortunately had people have to sell their house and leave. I mean, they become a house rich and cash poor. So there's different ways to do it. The president does want to do it. We can actually take the money out. You can also borrow from your 401k, and that's another bad idea because people think, oh, that's a great idea, and I love this one. I get to pay myself interest. Well, that sounds good, except you don't realize that you're paying 6, maybe 7% into your 401k. Well, the investment you had in there was maybe going to earn 8, 9, 10%, so it compound more. Then also people don't realize this. You put that interest in, you've paid tax on it already. When you pull it back out, you pay tax on it again, double taxation. So these are little tips that people don't know about.
Speaking of, I mean, you're an expert on finances. How predictable are interest rates? I mean, do you have systems that you use to forecast, or is it that they could change at any rate? When we think about that future, we don't know what the future holds financially.
You know, we really do have a crystal ball in our office, and it just does not work very good. I mean, nobody knows what way rates will go, and we do have a thing. We'll be talking probably next week about the Federal Reserve and how they work, because people think, oh, a new Fed chairman is going to change things. It's so complicated how that works, and nobody really knows how rates will go. It depends on inflation, depends on employment, depends on the economy. There's so many factors there. We do know ranges that we predict, but even with that, you can be wrong. And I've been doing this for over 40 years. That's why I love it. You never know what's going to happen. So you do the best you can predicting and investing based on that.
It's probably hard to talk, especially to young couples, about something like this, because maybe somebody's really young and early on in their career and they're like, I don't have the money now, but I've got big hopes and I know I'm going to be rich later. How do you talk to people about balancing their finances when they're at the beginning of their careers?
It's very hard. I tell them to be patient because everybody wants to hit the home run. And I say, don't hit the home run because you're going to strike out. And that's why, you know, older people, they don't take risk on investments because they've already lost money investing high. So, you know, I tell people, be patient. You've got the benefit of compounding, which is very strong. We've talked about that before. And, you know, buy a home. Maybe you can't afford a home now, but be patient with it. It is kind of funny. A lot of young people bought a home before. They hate it. They didn't realize they had to cut the grass and trim the bushes, and I got to paint the garage door and all these maintenance things that you have to do. And the cost of insurance is so high now on homes. And people say that's the insurance companies. It's really not, because what it is that the houses used to be $400,000 or $500,000. Now they're $900,000, $1 million. So the insurance, can insure a higher cost of an asset. It's going to cost you more.
I actually enjoyed being a renter too, because it allows you to decide what you're willing to live with and what's really important to you. So like when it comes to making that big investment of buying a home, you know what you're willing to sacrifice or what is a no wiggle room zone. When it comes to the future, you talked a little bit about this, but tell me a little bit more about how borrowing against yourself can create income problems once you retire.
Yeah, there's another one they came out with too, where you can put 10% of your home would be in your 401k. Sounds great, gee, home appreciates, my 401k goes up. But when you retire, you can't take income from that. You can't sell off, 0.1% of your home equity to pay yourself each month. So it's a terrible idea. It'll look nice as you're growing it, but then eventually you have to liquidate that asset, and you cannot liquidate 10% of your home to put in the 401k. So, I mean, these ideas are trying to come up with things to make it beneficial, but just sometimes the economics don't work out. And we've done very well in real estate for the last 7, 8 years. We're not going to do that going forward. So be patient, enjoy renting for a while, save your money, invest your money, be patient there.
All right, well, Wilsey Asset Management, you may not have that crystal ball, but you're the closest thing to it. You're very smart. You give people great advice.
I have it. It just doesn't work.
We'll work on that. All right, don't go anywhere. We'll be right back.